All right, let's talk now about capacity. Capacity is your ability to repay the loan. They want to know, the banks want to know if you can repay the loan. Well, for instance, do you know Donald Trump's credit score? I don't think so. I don't think that it matters because he has enough money to pay back. So he has the capacity to pay back, and the way that the bank view the capacity, and they look at your debt to ratio, and then how much money you have in your bank account, what is your monthly average balance. All credit are not equal, of course, but they make a distinction between revolving and mortgage. You have to balance that out also. Debt coverage ratio, which is your total income divided by your operating expenses. That's for your business. So if it's one, that means that your income, the income of the business, is equal to your operating expense. It's okay. But if it's two, then it's better because your income is twice your operating expenses. Guess what? If they have two people and one is the debt coverage ratio is two, they prefer that person because he got more income than this first person. So you want to know exactly what those numbers are. So those are very important. Rent roll, your mortgage payment, all that is important because we're talking about capacity or repay the loan back, and you want to show the bank that you have the capacity, you have enough money in the bank. Your debt ratio is good, 30% is good, that you can pay the loan back. And here's a big secret to increase your capacity. Use your business line of credit, which is unsecured line of credit, to lower your personal debt to ratio. I do that all the time. I look at my credit score, great credit score, and sometimes if I have my personal loan, my personal credit card, I can just use my business credit card and I pay 5,000 down here. And it's not showing up on my credit at all. That's the beauty of a business line of credit. You use it to lower your debt to ratio. Now you bump up the capacity, your capacity to pay back new loans. So all those things have to be understood before you go and see the bank, because when they look at you, they turn you down and they put an inquiry into your credit. Sometimes it's a little too late. You have to dispute that inquiry if you want to dispute it. So you gotta balance the business line of credit and your personal line of credit, and this is very important. So this is one way to really adjust your capacity. Now let's talk about collateral. Do you have anything to secure the loan? Loan to value. You can cross collateralize with another property, or you can use some cash value like your life insurance, your personal home. You can apply that as collateral. I don't like collateral at all. I don't want anybody to cross collateralize anything because I want to free up this equity, and then if I need money, I can go. So the collateral, I don't really want to give it away. So if you don't want to give collateral away, yeah, then you have to go and increase the first two we talk about, with character and capacity. So all these need to be balanced out. You don't have to have the 5C. You just need to have some of them. And collateral is one I personally don't want to use too. Now let's talk about the fourth one, capital. How quickly can you be liquid? How quickly can you pay back? Can you have cash in the pocket in the bank? Well, first, to improve your capital, you have to increase your saving. You have to decrease your expenses, and of course, you have to increase your net worth, which is that well, if you can transform some equity quickly to your bottom line, then you can get cash. But there is a difference between having real estate equity, business equity, and bonds or stocks that you can transform quickly into equity. And the banks know that. They look at the equity. If you're in a bad market for real estate, they know you cannot transform that quickly into equity. If you are stock that are appreciating, then they know that you can sell it quickly and pay them back. Here is a tip for you. If your business is not doing well, file an extension to delay tax return and use your best year. Then you show good money in the previous year and you haven't filed tax yet. So you just wait until later on, then you file the tax. Then you may have the line of credit that you deserve. And here is the last one, the last C. We're talking about the C's. So we have now a condition. What is the market condition at the time you're applying for the loan? And they understand that. So sometimes it's a bad global economy. The Federal Reserve may be having problem not injecting enough cash in the market. The interest rates are low that many the banks want to make loans. Consumer indicator, housing market may be good or bad. Buyers market, sellers market. As I'm tapping this in November 2008, we are having a crisis right now. Money is not readily available. The Fed have injected $700 billion in the system. It's no avail, and Obama is talking about injecting more. So the housing market is not very good right now. It's a buyer's market. So all these affect the way the banks look at the system. So sometimes they can just uh, say, we're not giving you any working life credit. I have a lot of friends now. They have good line of credit. Unsecured line of credit that has been cut back. Some of them have to use the line of credit just to be able to preserve the line of credit, because if you use it, they're not going to cut it back that much. So all these are conditions that may affect the way the bank look at you and look at everybody else. So before they give them the loan. So we talk about the 5 C's. They are very important. We talk about Don's number. We talk about how you can have a good payback score, and we talk about the 5 C's that you need to pay attention to. But the good news is that is money for your deal. Someone somewhere has money for your deal. That's a sure thing. It may not be a banker here, maybe a banker from Canada or from Europe, but someone will finance your deal. And that's good to know, because the bank need to make loans, because that's how they make money. That's how they feed their family. So you may be missing one of the C. For instance, you can borrow someone else's credit. You remember we talked about credit. You can borrow someone else's capacity to pay back. So you don't have to have the 5 C. And friend, you really have to be proactive. This is the word. It's very important. It's an adjective, but you really have to go out and be proactive, and going out and align financing in advance. And as a business owner, as a real estate entrepreneur, you are the one in charge for the financing in your business. And I always say that you have to do 3 things, at least 3. The first one is marketing. The second one is bringing the money, which is really going out and finding the source of money. And the last one is networking. Those 3 you have to do. Sometime you may want to do the sale also, but usually you can train someone to do that. But marketing, financing, networking, that is your job. I want to adjust it to this quick video without talking about private money, other people money, other people IRA, people who are losing money in stock market, people who have money at 3% in CDs. But come down to the same thing, which is being proactive, talking to people, and people knowing what you're doing and knowing that you're successful, and people will definitely lend you money at 12%, at 10%. And this is very important. I mean, I may be a little redundant, but this is sometimes the key for your business to succeed. So I leave you here with the thought that you will go out, and instead of spending time to really just do one thing, which is painting or doing the job, you would go out and really align financing in advance, so that sometimes you can just partnership with someone. Not a lot of people know this stuff, and it's so amazing that it's hard for people to really take in time and build a financing and have $500,000 secure line of credit, $1 million working line of credit, and start playing with this money. I'm talking about playing in the good sense that you go out and look at deals and you pick the real good ones. Why? Because you understand this financing part of the deal. This is so important that you have to do it. You have to start looking at your personal credit score, business credit score, the payback we talk about.